I think what we're seeing now is an interesting combination of the January effect and FOMO. Let me explain a little further. What we saw, I think, going into the end of December was year-end profit-taking, year-end book squaring gone awry. And what happens is in December is you typically see portfolio managers selling losers if they've been having a winning year. It's a good way. It's a good way to balance the books, especially if you're taxable. You should certainly be thinking about harvesting losses if you've harvested gains throughout the year to minimize your tax liability. And I think you had a bit of book squaring. That is normal. People want their portfolios to look a certain way. What I think went a little haywire in December, in hindsight, is that I think a lot of the squaring found that there were very poor liquidity conditions. Everyone was seemingly trying to do the same things. You had a lot of momentum stocks that had been market winners failing on them, and that led to this sort of very vicious feedback cycle. Nothing seemed to be working except for cash. And as a result, when the only thing working is cash, then everybody tends to run in that direction. It's, think about being on a boat as you go by the Statue of Liberty and everybody runs to the one side of the boat and then everybody has to run back to the other so the boat doesn't tip over. That's that kind of imagery, is everybody sort of rushed to cash because it was the only thing that's working. Well, therefore, if cash is the only thing that's working, you certainly don't want to be the one guy who doesn't have enough cash at year end, and that becomes a very vicious cycle. And we really worked our way through that, and you saw that end pretty much Christmas week, more or less around the time that you would have had to be done selling before the end of the year, especially when you include the settlement cycle. So that was your logic there. And January, one would expect to see what you historically call the January effect, where new money comes into play. Those same losers that were sold out in December are often bought back. In some cases, investors have to wait 30 days. Again, if you've tried to harvest the tax loss, you usually have to wait 30 days. But you can then come in and buy something like-minded. It's typical to see the markets enter the year with a bit of enthusiasm, and I think that's what we're seeing now. And in the same way that you saw the rush to cash at the end of the year, now you're seeing the fear of missing out. Oh, the markets are rallying. Oh, gosh, I can't be underinvested. I've got to be in it. I'm missing this rally. There's all kinds of great stocks out there, and so it goes. And so the lesson we learn from this is, and while we're seeing it now, we're right around, as I'm taking this, right around that 2,600 level that everybody's been focusing on. Why? Because that was support for a while on the way down before it broke. Support usually becomes resistance on the way back up, and so here we are. The market's been very buoyant, so it sort of always feels like it's going to bust right through it. We'll see where that takes us. There's no shortage of exogenous news coming on the horizon. Specifically, as I'm taping this, we're about to find out what's going on about Brexit. So all bets are off there too. So there's so many international and national events that can provide catalysts in one direction or the other. So I'm not going to go too far in one direction or not. But the lesson that I want everybody to take away is don't lose your head. If the market's selling off, don't run in there and panic. Figure out if you're overexposed, you should be figuring that before the market starts to fall, rather than while it's falling. It's much easier to sell when the market's stable than when it's not. And you should always be thinking about, am I too long in one direction, or are my exposures the way they should be? What's my balance between cash and stocks or fixed income and stocks? Am I at my optimal levels, or am I too concentrated in one particular name or not? That's the sort of thing you should be doing all the time, not just when the market is going against you. Secondly, resist the urge. It will also help you resist the urge to just jump in when everybody else is jumping in on the positive side as well. If you're disciplined in keeping your exposures proper, or you're responding to larger exogenous global type of events or company-specific news, that's the kind of thing that's best to be done on an ongoing basis. So there are no shortcuts, and I guess that's that's what you need to keep in mind, is do your homework. Keep doing this stuff. If you're investing every day, trading every day, you have to be on top of this stuff on a regular basis. You have to know where your risks are. You have to know where your overexposure is and where your underexposure might be. And think to yourself, all right, if this market's going down, am I okay with it rallying back if I'm underinvested? If not, well, maybe you should also think about not being underinvested if that's your case. By the way, that's the sort of thing that should only apply to professionals. If you're an individual, there's no such thing as being underinvested. On an absolute basis, it's only relative to your own market desires. A professional has a different problem. He or she has to have some sort of weighting in the market that represents what they've told their investors they're going to be. So there are advantages if you're relatively unconstrained. So keep your head about you, both in a down market and in an up market. We've seen more or less over the course of the last 2 months of trading days, 2 sequential one-way markets. Those can be very treacherous. Stick to your knitting, know what you have, know what you want to have, and keep your discipline, because these are the type of markets that really shake people's discipline and come back to haunt them if you get whipsawed.